Assalamu alaikum. Welcome to my YouTube channel. Today the topic of my video is unsecured loans, borrowing without collateral. What is an unsecured loan? An unsecured loan is a loan that does not require any type of collateral. Instead of relying on a borrower's assets as security, lenders approve unsecured loans based on a borrower's credit worthiness. Example of unsecured loans include personal loans, student loans, and credit cards. Key takeaways: an unsecured loan is supported only by the borrower's creditworthiness rather than by any collateral such as property or other assets. Unsecured loans are riskier than secured loans for lenders, so they require higher credit scores for approval. Credit cards, student loans, and professional loans are examples of unsecured loans. If a borrower defaults on an unsecured loan, the lender may commission a collection agency to collect the debt or take the borrower to court. Lenders can decide whether or not to approve an unsecured loan based on a borrower's creditworthiness, but laws protect borrowers from discriminatory lending practice. How an unsecured loan works. Unsecured loans, sometimes referred to as signature loans or personal loans, are approved without the use of property or other assets as collateral. The terms of these loans, including approval and recipient, are most often contingent on a borrower's credit score. Typically, borrowers must have high credit scores to be approved for unsecured loans. As unsecured loan stands in contrast to a secured loan, in which a borrower pledges some type of assets as collateral for the loan. The pledged assets increase the lender's security for providing the loan. Examples of secured loans include mortgages and car loans. Because unsecured loans require higher credit scores than secured loans, in some instances, lenders will allow loan applicants with insufficient credit to provide a cosigner. A cosigner takes on the legal obligation to fulfill a debt if the borrower defaults. This occurs when a borrower fails to repay the interest and principal payments of a loan or debt. Important because unsecured loans are not backed by collateral, they are riskier for lenders. As a result, these loans typically come with higher interest rates. If a borrower defaults on a secured loan, the lender can repossess the collateral to recoup the losses. In contrast, if a borrower defaults on an unsecured loan, the lender cannot claim any property, but the lender can take other actions such as commissioning a collection agency to collect the debt or taking the borrower to court. If the court rules in the lender's favor, the borrower's wages may be garnished. Also, a lien can be placed on the borrower's home if they own one, or the borrower may be otherwise ordered to pay the debt. Defaults can have consequences for borrowers such as lower credit scores. Types of unsecured loans. Unsecured loans include personal loans, student loans, and most credit cards, all of which can be revolving or term loans. A revolving loan is a loan that has a credit limit that can be spent, repaid, and spent again. Example of revolving unsecured loans include credit cards and personal lines of credit. A term loan, in contrast, is a loan that the borrower repays in equal installments until the loan is paid off at the end of its term. While these types of loans are often affiliated with secured loans, there are also unsecured term loans. A consolidation loan to pay off credit card debt or signature loan from a bank would also be considered unsecured term loans.